So guys, let's start this. So if you guys can see my screen, I posted the updated position size calculator out there in the training room. You guys can download it and use it. The only thing it is on this one, on the original one, it was just MNQ and NQ relation, but this one I threw the MES on there because some of you guys just trade the MES ES pair, so you guys can use the second tab to calculate that. So briefly, just the first understanding of the calculator itself. So this is the style of trading that I've been using now for years. It's designed around the ideas to. There's so much variables in trading that the more variables that we can control and turn into constants, the better at least the returns should be, and better it allows less user error and allows your strategy really to shine, or at least to show you that it's not working. But the key is, like, when you have too many variables, that's when things start falling apart and you don't necessarily know what's causing it. Is it the strategy itself? Is it the user error? Is it over leveraging? It can be all those variables. So the key, like, I mean, just based on my time trading, like, just the biggest difference that I found through my learning curve, the difference between like a professional and amateur in any field, is consistency. And so it's like, the way I look at it, like, life is random enough to where, like, an amateur can have success in a day or two in a week. But to repetitively being able to do it, day in, day out for months and years, like, that takes a special kind of system. And to build that kind of system, like, that's pros really build off of professionals that do this, to really build off of consistency. And how do they do that? It's through controlling as many aspects of the process as possible. And so with this calculator, we take one component, which probably is the biggest component of trading, in my opinion, is that's the risk management of capital. And we turn that into a fixed constant. And how do we do that? So with my style of trading and position sizing, I go into, I go into my equity and I say, okay, I have this much equity. Like, for example, let's use $10,000. So I'll go in and say, I don't want to trade. Like, I don't want any one specific trade to be more than 1% of my total equity. So as that, the results would be $10,000 times 1%, giving me $100 per trade. So no matter how good or how bad, for me, it becomes a numbers game. And so the number is, as long as I can exceed the return versus the cost of doing business being the stop losses, then I should end each week on a positive aspect. And by doing that, I use a specific, so in this situation, I want to do 1% per trade. So I come to the calculator here and I trade mainly MNQ, NQ pair. So I'll come in here and I'll look and say, okay, so this week, for instance, I've got 10 grand. So each trade will be $100. So I'll use this line here, and based on the setup. So let's say I get something between, I don't know, let's ballpark of 5 to, let's say 5 to 8, 5 to 10 setups per day. And so the key for me is, like, I'll show you an example of it in the chart here. So I highlighted an area where it could be a possible setup. And let's say setups for me tend to happen more around pivots. So let's say this area that's highlighted here, let's say I like how this is formed here. I think it's bottom of Bollinger. Let's say the overall trend is up, and I feel this is an oversold level. So I'll look at this part here, this pivot, after it's formed, and I'll say, okay, so how large, if I want to get in once this pivot's formed, how large of a zone is this for me? So for instance, the high of, let's say, this candle here is let's call it 16,160, and the low of this candle here is 16, let's call it 145. So we got about a 15-point zone here on this MNQ pair. So I know my zone size now, it's 15 points. That's going to be like, and I'll probably add like a tick or two just below the zone for the stop loss. So for the sake of easier calculation, let's say 16 points is going to be the risk here. So for me, it's irrelevant whether this is 16 points or this is 50 points or 100 points, whatever the size of the zone is. At the end of the day, I want to risk $100 no matter what size the zone is. So what I would do on this one is say, I've got 16-point zone there, and I want to take that trade. So I'll come in here and say, okay, so I'm risking $100, 1% of my capital. And I'll look up here, and I've got a 16-point zone. So this column here is the 16-point zone. So where your capital at risk and your points in risk match up, right there you'll see a number. So for instance, this example is 3.1. So what this will tell me is, for that specific trade that I want to go long in, I can go up to 3.1 contracts of the MNQ and be at my $100 risk. So for that example, I want to take that trade. I'm going to go long 3 MNQs, and I'll look for a multiple of that risk to get out. So what I'll do for that is, I've built another calculator down here. So what we'll do is we want to go long, let's say. So you'll put an L in here for long. Then you'll figure out what's the high of this zone. So we'll put 160.25. And the low of this zone is 145.25. So what that'll do is it tells you that's about a 15, and this rounds. So that's about a 15-point zone. Let's say our risk, we can put whatever it was. For this example, we used 100. So we got $100 risk on a 15-point zone, and it tells us that you should go 3 contracts in. So what this does, especially with me, like I'm trading the 1-minute chart, so there's so much happening that I need as much help and calculation as quickly as possible. So I use these things so I don't have to manually do it. So I'll just put in my risk at the beginning of the day, and then I'll just change. Every time there's a new zone, I'll put in whether I'm going long or short, the high and low, and it'll tell me how many contracts I should get in. And here on the left here, you've got your multiples chart. So what this does is, if it's a type of zone, minimum, absolute minimum, I feel it should be a 1 multiple. So if I'm risking 15, I better at least get 15. And in that situation, I better be hitting at like a 55, 60% clip to make profit for the day, including with commissions and things like with slippage and stuff like that. But preferably, you want to probably be in the 1.5 to 2.5 up here. Most courses, they'll teach a 2 multiple for your risk to reward, which is pretty safe, because then if your strategy is not hitting at, let's say, 33% clip, that's what it takes to be profitable. So if the strategy is hitting at a 40% clip with a 2 multiple on your reward, then you're going to be making money. And so what that'll do is, so you've entered your high and low of the zone, and and at the exit value, this will tell you where your target should be set at if you want that multiple. So for instance, 16,175 would be a 1 multiple, 16,190 would be a 2 multiple, and so on, depending on what kind of multiples you want to get within your strat. And so these, to really know the number, like 2 is safe, but with a black box systematic approach to this, you kind of need to know your strategy well enough to where you need to know the percentages of how often these things hit. And but I would recommend starting out on the safe side. Start out with the 2 multiple with the constant fixed capital risk, and then at least if you see that you're not achieving that 33-34% success rate, then you can really dive in more into the strategy of what you're doing. And to me, this is how my strategies and my algos are based off of. It needs to be, for me, the key is something that I can do repetitively over 1,000 times. And I've talked to a couple of guys in here. I've talked to ProShot, and I've always said, like, your strategy, what is the results if you do it 1,000 times? Like, I don't feel comfortable with someone telling me, you know what, like, I was successful today, and I asked them, like, you know, what's your success rate, or what's your profit expectancy, what's your numbers, and they're like, I don't know all that, I'm just going off of a gut feeling that it's going to work. Well, your gut feeling is not going to get you end of year 1, end of year 2, end of year 3. Like, things will blow up way before then. And I know a lot of you guys are doing combines and stuff, and like, the goal is to pass these combines, but I know a lot of you also get into funded, and then it seems like you guys are like deer in headlights, and it's like couple of days in funded and it's back to the combine. So, like, the question is, if you want to be a professional combine taker, like, that's a whole different road. But I'm coming from the side of, like, in the real world, day in, day out, lots of trades per year, how do you come up with a profit situation where you're not blowing accounts? Because it's, I don't know, to me, it's the idea of the idea of passing a combine, I feel like it's there's a switch that they don't teach you, and it's like they give you these we're trading a highly leveraged product, and they're giving you, in my opinion, too much leverage power, but it's fixed in your mind that, for instance, I've got to pass this combine within a month or two because I don't want to pay $200, $300, $400 a month in subscription fees. So how do I get out of this combine as fast as possible? So you train your mind to think like that. And once you get through the combine and you get through the steps and now you're in a funded account, someone doesn't come and turn off that switch, because you can't, if you're going to 0 to 60 in a drag race, you can't keep that up long term. Like, that's why drag races are so short. So the idea is you've got to, when you get to the funded, somehow you've got to turn off that switch and everything that you've learned in that process into realizing, okay, in reality, I don't have a $150,000, $250,000, $300,000 account that I'm trading here. I've got a $3,000, $4,000 small account challenge. But nowhere does it say that on any of these sites. So what they're saying is that, try at test runner 150K combine. You don't have anywhere, you have 150K of margin power. What you have is a $3,000 small account challenge. And I would not recommend to anyone who wants to do this for a living to even say the word minis while you have a $3,000 account. Because if any of you guys put $3,000 of your own money into a actual brokerage account, I would highly advise against trading a mini unless that strategy you've tested and the numbers are solid, your execution is solid, you don't have any holes in your game, and you've done this before, and it's just like you're on another level. But the 99% of people who aren't at that level, you've got to think like on using the micros. And but once again, that's a switch you've got to turn off, because it's not the micros that got you to the funded account. So you're like, heck, if minis got me to the dance, let me continue doing what I'm doing. And more times than not, you're going to lose that funded account fairly quickly, and you'll be right back in the combine. And I've talked to a couple of guys about this here, and like this whole mini versus micro, like, to me, those are just words. Like, there's no like inferiority, superiority. Like, oh, some guy trades minis, some guy trades micros. Heck, even Ghost taught me the word like cars now, which is like, I don't know, 5 minis or 10 minis like per trade. So the idea, like, more or less, like, you're not here to flex. The key is you want to be here in a year doing this. And the only way to do it is to have your risk management down tight and know that this one trade will not blow up my account. And second, even above that, is allow yourself to have a bad day in the week, or maybe even 2 bad days in a week. But most of the combines and the accounts that I've seen with the guys in these servers, you guys don't allow for a bad day. A bad day means you blew up the account. And in the real world, if you blow up an account in a day, like, game's over. So I don't know what your plan B is. So you need to allow yourself, say, I'm going to hit, let's say 30, 40, 20, whatever the number is, trades per week. And when I look back, I started on Sunday night or Monday, and at the end of Friday, when I do my data collection and I look through all my trades, that's where you need to be green, in my opinion. But it's okay if like Wednesday was just, a horrible day for your strat, and all of us have that. I mean, I've worked on so many algos, and I can't find an algo that doesn't have a bad day. But the key is you've got to survive that bad day. You can't dig a hole so deep that the rest of the week you're just trying to barely get out of it. Like, that, to me, you cannot have a successful strategy. So these strategies, that's why this fixed capital at risk comes into play, and that's why a positions sizing calculator needs to be in effect in some sort for your strat. Is if you're taking, let's say, 1% risk per trade, the maximum loss for that trade when you're wrong is 1%. You're not in. These are the kind of things where you shouldn't be moving stop losses. That 1%, you take it and you put on the next 30 or 40 trades, and you move on from there. And so the different aspects of this trading, one is the risk management, one is the most important to me. Being another note, having to be able to absorb bad days per week. You've got to be able to do that. You've got to pay yourself correctly with the multiples that we're seeing here. So, for instance, if you're taking 2 multiples for every winner, and you're only losing 1 multiple per loser, then as long as you're hitting that 33% clip success rate, then you're going to have a successful account at the end of the month, end of the week, end of the year. And that's what matters long term for us guys that do this for a living, that we don't have the luxury of saying, you know what, if I blow up my account today, it's just $100 reset. Like, we don't think like that. And so if we blow up an account, we're done. Like, this is our ways of putting bread on the table. Like, this is how we live. And so these are the kind of things that we have to take seriously. And for us, it's not $100 reset. And so that the main reason I did this position size calculator, because so with some of you guys, I'm fairly close to become friends, and I see some of you guys doing repetitively the same thing, and like I'm funded, we celebrate. 3 days later, I'm back in the combine, and like I asked myself, like, well, what did you learn through that? Like, it took you 3 weeks to get funded, and you're right back in the combine, and so it makes me question you need to ask yourself, what is your game plan? What is the end game here? Is it you want to take 10, 20, 30, 40 combines? Well, then, hey, man, the more the merrier. Do what you got to do. But if your goal is to ever do this for a living, like, the mental switch is completely different. Like, you can't think like that. Like, $100 resets don't exist in the real world. And so when you're given that funded account, tell yourself, like, you got to find attachment to it. Like, it's easy. Once again, it's much easier when someone else's money on the line. But if you tell yourself, I put $2,000, $3,000, $4,000 of my own money on the line, am I really going to put a 3 mini contract or a 5 mini contract? Or you wouldn't be talking like that, because the first time you lose $1,000 of your own money, you're like, oh shit, like, what was I doing? What was I thinking? Like, and so come back to this position size calculator idea, and you'll realize you've got to put some kind of fixed percentage of capital on the risk, and that's related to how much equity you have on the line, and move forward from there. So that's just, I wanted to give you guys this calculator so that you guys can approach this with the mentality of what the rest of us do, who do this for a living, and not for some combine to get funded and blow up and spend another $100 on a reset and stuff like that. So take a look at this. You can use both MES and ES. And let me see, what else I want to tell you guys about this. So yeah, keep that in mind, that difference between a pro and an amateur is, even a broken clock's correct twice a day. That's what they say, right? So, but you want to be right a lot more than that. And to do that, you need to have consistency. And the way to consistency is just to control as many aspects of the process. So another thing, so the way traders go, I think of, like, there's 4 types of traders. Like, there's ones who are consistently losing money. So they don't learn to manage the risk. They'll blow up anything they have, whether it's their own money, whether it's these funded accounts. Like, they're just off the track. Like, they might as well be in Vegas, might as well go play roulette. You probably have better odds putting it on black or red than to do it in this game. Then there's, like, the break-even traders who, like, learn the risk management, but they're not profitable. And so they try to learn to control the risk, but the strategy itself on the profit side is not paying out. So they're pretty much near break-even for most of the time. They just don't get that lift that they need. And then the next level will be like a profitable trader who learns both the risk side and learns how to take the profit side. And then there's that top 1%. Then there's the LeBron James and the Michael Jordans, who are the highly profitable ones. And what they do is they completely understand the risk management side of it, and they just learn how to exploit the profit side. Like, they can look at a setup and say, like, for instance, this setup, I'm going to go with 3, 4, 5 multiples, just because I've seen this repetitively so much in back testing and looking at this. And they know whether this setup should be a 1 multiple or this setup should be a 5 multiple. They know those things just because they can literally feel what's about to happen to the right of the chart. And when you create your strategy and when you're going through these things, the key is, like, when you're looking at charts, it's easy to build, when you go back and you back test a strategy, it's easy to build a subconscious bias by seeing what happened in the next 10, 20, 30, 40 candles. But the key is when let me use this example. So when this setup right here occurs, I don't see the next 10 candles. All I see is this one candle that I've decided I'm going to go in. But when you do this enough times and you learn your strategy well enough, you can start predicting what the next 5 to 10 candles will look like and what you expect them to look like. And if they don't look like that, then that's when your risk management kicks into place. So when you run a back test on a strategy you're building, really try to avoid seeing too far ahead. Like if you tell yourself, for instance, some kind of indicator tells me like this is the area, or this is the zone that I want to get into. Well, block out the rest so that you start memorizing what it looks like here. Because once I see the rest of this, I'm like, oh yeah, it's real simple to say, yeah, I would have taken that. That would have been a nice trade. No, well, I wasn't saying, yeah, I'm going to take that and it's going to be easy when this is all I saw. Here, there's a whole lot of hopium involved that it gets there. But the one thing I knew is I controlled my risk. That's the only thing I knew. That was the part of the process that I had in control, was no matter how bad this trade turns, I'm going to only lose $100. But when those highly profitable guys, they see these setups enough to where they can start predicting what the next 10, 20 candles should look like. And that's where eventually you want to get. Like that's the upper echelon of this field that we're in, this line of work, is when you can start seeing those things. And the further back you go, the more back tests you run, the more candles you see, the more screen time you put in, you'll get a better feel for what you want to do with your strategy and how it should play out. And when it doesn't play out, when you start not seeing it correctly, it explains a lot of your questions. But try to definitely avoid the right side of the chart, because in real life, we don't know what the next 10 bars are going to look like. So in backtest, you shouldn't have that luxury as well either. So put that down. What else that I want to talk to you guys about is the two parts of every trade, as we talked about: managing the risk, managing the profit. Those are the two things you want to control, not allow them to be variables. Third thing is so risk management. Build a positive expectancy strat, something you've back tested that it's just, you're not rolling dice. Like you're picking areas that you're getting into that have an expectancy that it should be profitable. And once you get those two components, the risk and the positive expectancy of the strat, to where it leads to the profit multiples, more or less you're just rinsing and repeating. And a lot of you guys have heard like that. Good trading, profitable trading is a boring aspect, and that's why it's boring, is because once you get those components down, you're just literally rinsing and repeating. There's no more adrenaline pumping like it is at the beginning, where you're throwing on these big lots and you're seeing these P&L swings with large numbers, and it truly feels like you're in a casino. But when you've got these dollars at risk numbers down, like if every trade's $100, after a while there's no adrenaline, because you're like, okay, like this 100's gone, this 100's made, this 100's gone, this 100's made. And it just becomes it becomes a mathematical game of whether you're going to make money or you're going to lose money. And you try to remove this mystery and doubt and hopium and things like that from it. And whether your gut feel will lie to you, the math won't. And at the end of each week, when you do the math of what happened in that strategy, that is about as close as you get to the truth in this game. Because there's a lot of times when you have a gut feeling something's going to do something and it doesn't. So your gut feel is going to be wrong. It's going to be wrong a lot more than the math of the actual strategy will. And so have those things when you talk about a strat, when you're looking to improve a strat, you need to have these things, these variables under control. And then like a good strat, like you got to remove the FOMO. Like you can't FOMO into anything. Like this fear of missing out. I would say I'm more of I lean on JOMO instead of FOMO. Like I get a joy of missing out on something, because like I'll wait for the next one, but it's fun watching it, so I get a joy out of it. But with a good strat, you should never be just clicking the market buy, market sell if that's not part of the strat. Just because if that train's left the station, like wait for the next station. Like don't get into there, because once you do that FOMO, your dollars at risk doesn't make sense. The place where you're putting your stop loss most likely doesn't make sense. You're just it's the Wild West then. You're just pushing buttons and hoping things work out, but I guarantee you that's not going to survive 1,000 setups doing it that way. So that's another component. And tell yourself, when you start the day trading, tell yourself have a good process day. Don't tell yourself have a good trading day, because trading day, it almost means that, like whatever happens. But tell yourself today I'm gonna have a good process day. At the end of if you executed your process correctly and had a losing day, you should still have a smile on your face, because you showed up with a strategy that you've backtested, that you feel works, and you committed to the process and you executed the process, so there was no user error involved. You executed the process and you ended up with a bad day, I can go home with that every day of the week. Like I've told guys, like I'll go bankrupt trading my setup because it's all about the process. Like for me, a losing day is irrelevant because at the end of the week, end of the month, end of the year, when I have those hundreds and hundreds or thousands of trades, it's going to show if the process was correct or not. So really try to control the process of these things, and that's truly the way to make capital in this. Is it's like before I started before I started really get into like heavily day trading, like poker is a huge favorite game of mine, and for me these two have the trading and poker have so much in common. It's I feel like when I'm sitting at a poker table or when I'm trading, the similarities is irrefutable for me, and so it's the same thing. Like if you've got in this game, if you've got pocket aces versus pocket kings, you're a 4-1 favorite every time. So it doesn't matter what that specific situation is, as long as you do that play repeatedly every time, you're going to go ahead 80% of the time. And so make a process that you can stick with, make a strat that has positive expectancy, and have on the risk management side something you can control, to where all of a sudden that $100 risk doesn't turn into $500, $600, $700, because now that was never part of the strat, and now digging yourself out of this hole is going to be a much different concept. So keep that in mind. And this idea of mini and micro, like it's words. Like it has no meaning. What has meaning is what you guys are seeing on this chart. If this tells you think of it in terms of contracts. Don't even speak in like mini and micro terms. Like if $100 is your risk and your stop loss is at 15 points, and 3.3 contracts is what you need. So I always just refer to, even if I'm referring to, like, instead of saying 3.1 minis, I'll say 31 contracts, because I find the lowest incremental value of movement for a product, and in this situation the NQs is the MNQ. And for my style of trading, if I need to keep the dollar at risk at such a specific level, it's tough for me to build that risk management with minis. So instead of trying to go in, if it requires for me to go 25 micros, if that's what this position size calculator is telling me, I'm not going to round up to 3 minis. Sure, it'll be cheaper that way in the commissions, but over 1,000 setups, that will create more damage to the account than me doing this. So think of it in terms of contracts. Find the lowest incremental product or the lowest incremental contract size that you can trade with, and then have the calculator tell you how many contracts you should go in based on how much you want to risk. And in this situation, like for example, if you're doing 150K, like let's say a Top Step account where you have, I think it's like $4,500 drawdown, if I'm not mistaken. So if tell yourself, I don't have 150K, I got $4,500. And if I've got $4,500 and I'm going to not going to go in more than 1% to 2% equity risk. So like 2% of 4,500 is $90. So you're going to be in this area between 75 and 100 if you truly want to, if you're in a funded account. I get it. Like step one, I don't want to pay $300 a month. So you guys get a little wild and take your mini shot at it, be aggressive and try to get through step one as quickly as possible. And step two, I know they have like some kind of scaling plan, but the main reason I'm doing this is a lot of you guys actually know how to get through the combine. So I'm not here to tell you guys how to get through the combine, because most of you guys can do that better than I could. But I'm here in the funded account world, and I'm trying to tell you, when you get here, you got to turn off those switches that got you here, because that's no longer relevant, because we don't want to send you back to the combine. And so when you get here, if you have the luxury of using this to get here, even better, because you'll just be more used to it when you do get here. But if not, when you get to the funded area, you need to have a strategy that uses this type of risk and uses it constantly. So I'm not going to take $1,000 risk on one trade and then take a $250 risk on the next trade and then take $600 on the next trade, because once again, you're creating a variable on something that should be held somewhat constant in a strategy, and letting the strategy do its work. So before all that, figure out, like, whether it's your own small account or you're in the funded account, like, allow yourself for bad days. Take if it's tough to make a living, with these really small accounts, but you've got to grow them organically. And the only way to do that is to go through this process of where you can turn a $3,000, $4,000 account into a $10,000, $12,000 account, and then allow yourself to move up inside of this calculator. Like, you're still going to be in here. So whether you're using this row in this column or this row in this column, you guys will be in here for life. Like, I've been doing this enough now in these years where like life exists in this row and in these columns. The question just is which one, which row and which column, which cell of this sheet are you in this week? And so keep that in mind and allow yourself just to have these bad days where like I'm not comfortable with some of you guys that are close to me telling me like, like I had a bad day so I blew up the count. Like that's just not acceptable. And so have a bad day, allow that during the week. And the only way to do that is to control the risk that you're taking. So if you have 5, 6, 7 bad trades for that day, and you need to also be able to step away. You can't just continually be shooting blanks all day. If you're having one of those days, walk away that day. Come tomorrow, all the market will be here. But what allows you to come back tomorrow without restarting is going to be this capital at risk. And when you've got that down as part of your strategy, then I think you're good to go, and you can see this account growing organically and have like a nice equity curve and things that we like look for in the real world. But I'm just trying to tell you guys that the $100 resets are not a luxury you're going to get on this side. And more or less that's it. You can use this chart. I created the MNQ and the MES for you guys, so both of those are there, and it'll tell you number of contracts. But you can adapt this. You can use a position. You can find out what the dollar per point movement of the product you want to use is. You can put that in here, and then you can see how that product moves. Like if it moves like NQ where it's 1 point at a time, you can keep this the same way. Or if it moves more like the MES where it makes more sense to do like quarter points at a time, you can use this. Or you can change the columns to match whatever product. I don't know, like some of you guys trade crude or gold or whatever product futures it is you trade. You can modify these columns and these rows to match up. I believe these rows will be pretty solid for the 99% of us in here. There's very few of us that are going to put more than $1,000 per trade of real money. But if you grow, I hope all of you do. If you grow past this, you can always just change these or add more rows and make the numbers bigger, and then just drag the cells to the cells have the equations in them, so you can just drag them down or to the right to fulfill what it is you want to fulfill. But I want to see you guys succeed. And with some of you guys, like, you've mastered getting to the funded, but staying in the funded seems to be the Achilles heel for a lot of you guys. And to me, when I hear that, it has to do with the strategy. It has to do with what you're risking. You're over leveraged. Your risk management's not correct. And those are the kind of things that it blows accounts way too easily. Like personally, I knew a guy who took 8,000, made it 52,000 in a year, grew it organically, was doing everything right. One day he just had a bias that the NQ was not going to go down. Like, it had to just be a long day. So he started long in 1 mini, started long in 2 mini, started long in 3 mini, and like he started averaging down. Next thing you know, 52,000 was gone in a day. That took him a year to build. Like, so that kind of revenge trading is so real. Like, it exists in the real world. And like, the biggest fear that we have that do this for a living is that, if you ask me what is my biggest fear, it's not about a strategy failing. It's about losing that concept of what I'm risking. And I know most of you have probably gone through this, and that's like when trades start going against you, it's almost like you see darkness. It's like an out-of-body experience that you're not there, and it's like this aggression, this rage kicks in, and it's like, no, like, I gotta be right, so I'm gonna average down. No, it's gonna go back up sometime. I'm gonna put on another, and it's just you dig a hole so big that most times you're not gonna be able to get out of ever. And so, but if you have a strategy that one loss, 2 loss, 3, 4, 5 losses is irrelevant to the bigger picture, that's the way forward. And so, removing that biggest fear is the key. And so for me, that's always been the biggest fear. Is I wake up in the morning and I'm like, I have the potential to blow up this whole account today, just pushing buttons. Like, I have that power, and that instills fear. Because when it's your own money and that's what's putting bread and water on the table, Like it's a whole different mentality than it's some kind of game or some kind of $100 reset. Like life doesn't work like that. And so I just wanted to show you guys what we do on this end. So when you guys, you make the move into a funded account, or, you have your own accounts that you're trading your own capital, just to help you guys understand it a little bit better and to use this calculator however you guys would like to use it. But this is the one thing that's helped me quite a bit, and it's helped me find flaws in my strategy. So because now it's no longer, when I do this, I know that the risk management side is held constant. So when things aren't working, I can go into the strategy and find out where are the holes, where are the better entries, where are the better exits, what did I do wrong, what kind of user error is there, and so things like that. You can find those easier when this aspect of it is held constant and is not a variable. But when this is a variable and that's a variable, man, you're just throwing darts in the dark, man. You have no idea what the hell you're doing, and things are gonna blow up real quickly. So that's what I wanted to tell you guys. I hope all you guys succeed and do what it is you want to do with this. But just wanted to give you my opinion from my side. I don't know if you guys have any question over this calculator, if there's anything I can help answer. But that is about it from my end, unless you guys have anything.
Appreciate your time, man. Appreciate it.
Yeah.